Right. Let's talk about something that'll make your blood boil. Your kid's wonderful underpaid teacher, the one shaping young minds? She probably forked over a bigger chunk of her tiny salary in taxes last year than some billionaire. Yes, a billionaire. Someone who could buy a small country or at least a very, very big yacht. How is this even possible, you ask, clutching your lukewarm cup of tea in disbelief? Well, it's not magic. It's the tax code, baby. A labyrinthine beast designed, it seems, by people who really like rich people. It's a system where earning a wage is taxed robustly, but making money from money? That's a different, far friendlier story for the wealthy. So, how do they pull off this financial acrobatics display? First up, let's talk about business structures. Most of us get a paycheck. Simple. The rich? They often don't just jobs. They, the companies. They set up things called LLCs, which stands for Limited Liability Company or full-blown corporations. Think of these as special financial suits of armor. They separate the person from the business. So, if Richie Rich's Rocket Rides Inc. accidentally sends a Tesla into the sun, Richie's personal collection of Fabergé eggs remains untouched. This separation isn't just for safety, it's a cornerstone of their tax strategy, a way to create distance and options. These business structures aren't just for show, they come with some lovely tax perks. For an LLC, profits can often pass through directly to the owner's personal income, avoiding a separate corporate tax. But corporations are where it gets interesting for the truly wealthy. While they do pay corporate tax, there are so many deductions, so many write-offs, it's like a discount shopping spree for tax bills. They can deduct salaries, even their own sometimes, operating expenses, research, and even the depreciation of that gold-plated coffee machine in the lobby. It's all about reducing that taxable income figure down to something laughably small. And this brings us to the crux of it. Not all money is treated equally by the taxmen. There's the money you from busting your hump every day, and then there's the money while you're, say, sunbathing on one of your many private islands. This distinction is absolutely critical. Regular folks mostly deal with income tax, which tends to be higher and harder to avoid. The wealthy, however, have mastered the art of making their money in ways that attract much, much kinder tax rates. It's a different world with different rules, and those rules are very much tilted in their favor, which is frankly infuriating. Now let's dive into the murky waters of capital gains versus income tax. Your salary, your wages, the money you get for actually doing a job, that's income. The government sees it, takes its cut, and that's that. It's straightforward, if a bit painful. But for the super rich, a huge chunk of their wealth comes not from a salary, but from their investments. They buy stocks, bonds, or entire companies. When these investments go up in value and they sell them, that profit is called a capital gain. And here's the kicker: capital gains are taxed at a significantly lower rate than income. Yes, you heard that right. Making money by money is taxed less. Why, you might ask, is there this BOGO sale on taxes for investment profits? The official line is that it encourages investment and stimulates the economy. Which sounds lovely, doesn't it? Like it's all for the greater good. But critics argue it's a massive handout to people who are already, not struggling to pay for groceries. It means someone who makes millions by clicking a mouse to sell some stock might pay a lower percentage in tax than a firefighter who rushes into burning buildings. It's a system that rewards passive wealth accumulation over active labor, and it's a key reason the rich keep getting richer while their tax bills don't always keep pace. This preference for capital gains drives a lot of financial planning for the wealthy. They structure their compensation to be heavy on stock options rather than massive salaries. They hold on to assets for at least a year to qualify for the lower long-term capital gains rates. It's all about transforming what could be high-taxed income into lower-taxed capital gains. Think of it like financial alchemy, turning taxable lead into tax-advantaged gold. It's not illegal. It's just using the rules of the game to their maximum advantage, rules that, coincidentally, they often have a hand in shaping through lobbying and political donations. What a remarkable coincidence, isn't it? Furthermore, the timing of when they realize these gains is also entirely up to them. If you earn a salary, taxes are typically withheld every paycheck. You don't have much say. But if your wealth is tied up in stocks or other assets, you can often choose to sell, and therefore when to pay tax. If the market's down or you have other losses to declare, you might hold off. This deferral is another powerful tool. It means their money can keep growing, untaxed, for years, sometimes even decades. It's like letting a cake bake for an extra long time so it gets bigger and bigger before finally taking a small slice for Uncle Sam. Alright, let's talk about property. Big, shiny buildings, sprawling estates. The rich love real estate, and not just because it's nice to own a skyscraper. It's also a spectacular tax shelter. One of the most magical words in their vocabulary is depreciation. Now, you might think a valuable building in a prime location would, in value, and you'd often be right in the real world. But in the wonderful world of taxes, owners can claim that their building is value each year due to wear and tear. This is a paper loss, mind you, not necessarily a real one. It's an accounting trick, perfectly legal. This depreciation deduction can be massive. It allows property owners to reduce their taxable income, not just from the property itself, but sometimes from other sources too. So, they could own a building that's actually making a ton of money in rent, but on paper, thanks to depreciation and other deductions like mortgage interest, it looks like it's barely breaking even or even losing money. This loss can then be used to offset other profits, shrinking their overall tax bill. It's like saying your prize-winning racehorse is actually a clapped-out donkey for tax purposes, even as it wins you another trophy. It's utterly bonkers, yet standard practice. Then we have the glamorous, if morally questionable world of offshore loopholes. This is where things can get even more complex and frankly a bit shady feeling even when technically legal. Wealthy individuals and corporations can move their money and assets to countries with very low or even zero tax rates. Think Bermuda, the Cayman Islands, or Switzerland. They might set up shell corporations or complex trust structures in these tax havens. The goal is often to legally defer paying taxes in their home country, or sometimes to avoid them altogether, by making it seem like the profits were earned in that low-tax jurisdiction, not where the actual business happened. The beauty of these offshore arrangements, for those who use them, is that they can legally keep profits accumulating in these havens for years, untaxed by their home government. Bringing the money back home might trigger taxes, but there are often ways around that too, or they simply reinvest it offshore. It's like having a secret financial garden where your money plants grow enormous, without the taxman constantly trying to prune them. While efforts are being made globally to crack down on illegal tax evasion, these avoidance strategies through offshore means remain a potent tool for minimizing tax obligations, much to the frustration of, well, everyone else paying their fair share. Now, not every tax avoidance strategy is exclusively for the mega yacht crowd. There are some tools that even moderately well-off people and sometimes even regular folks can use. I'm talking about tax-advantaged retirement accounts. You've probably heard of them: 401(k)s, IRAs, Roth IRAs. These are accounts designed by the government to encourage people to save for their golden years, which, given the state of pensions, is probably a good idea. The incentive? You guessed it, tax breaks. You either get a tax deduction now for the money you put in, or the money grows tax-free, and you pay no tax when you take it out in retirement. These accounts are genuinely helpful. If you put money into a traditional 401(k) or IRA, that contribution can reduce your taxable income for the year. So, you pay less tax. The money then, hopefully, grows over time, and you only pay taxes on it when you withdraw it in retirement. With a Roth account, it's the other way around. You pay taxes on the money you put it in, but then all the growth and withdrawals in retirement are completely tax-free. For the rich, who can often afford to max out these contributions every year, this is still a fantastic deal, sheltering a significant chunk of money from immediate taxation and allowing it to compound powerfully. So after all this, what's the big takeaway? It's that most of these methods the wealthy use to shrink their tax bills are, infuriatingly, perfectly legal. They are not necessarily breaking the law, they are using the law as it's written. The tax code is an incredibly complex document, thousands upon thousands of pages long, filled with deductions, credits, and loopholes, and it's been shaped over decades by lobbyists and lawyers representing powerful interests. It's a system that has, intentionally or not, evolved to favor those with the resources to navigate its complexities, or better yet, to hire expensive accountants and lawyers to do it for them. The truth is, the tax system is less a straightforward set of rules and more a game of strategy, especially for those at the top. Understanding these strategies isn't just for the rich. It's important for everyone to grasp how the system works, or perhaps, how it doesn't work fairly for everyone. Because if you don't understand the game, you can't really argue for changing the rules, can you? And believe me, these rules could certainly use a long hard look. and perhaps a hefty rewrite, preferably by someone who isn't currently sunning themselves on a tax-free private island. Thank you very much.